call it the Netflix for our mortgage industry and real estate as well. And today we have an all-star panel, and we're going to be discussing the current mortgage, the current market for the mortgage. I'm going to let them introduce themselves. They'll take about a minute each. And today we're going to have a
I'm Jimmy Hobson, JH Home Loans. Been in the business 4 years. I'm actually a broker. So I'm in great company, obviously. I'm the young guy here. But, I'm just excited to be here. Marvin invited us and happy to talk about, the mortgage industry as a whole.
And we have virtually our friend Kevin Peranio from PRNG. How you doing, Kevin?
Good. How are you doing?
Deaths related to COVID, almost 5 million infected with the virus, now in August, in the summer of 2020. So I wanted to have a conversation here with all the experts, all these professionals regarding what are they seeing, because one thing is not matching, unemployment, and in the other hand, mortgage lending or mortgage brokers, at least the mortgage broker side, is seeing
Just half refi, so I'm pretty purchase heavy, at least until last month. But it's craziness out there. I mean, I've still got tons of people shopping. We're seeing, houses that are 300,000 or less. We're seeing 10, 15 offers.
Wow.
And some people offering 20, 30 grand over. I know Lauren's seeing the same thing. It's just madness out there on houses that frankly aren't really worth it. And so in turn, we're seeing a lot of appraisals come in light, and people getting frustrated, but it's all part of what we're dealing with right now. In fact, I've had more appraisals come in low in the last
year on a 30 years, so it's just historic record lows.
Yeah, it really is. I mean, we're seeing it, it's in some respects, it's the culmination of a perfect storm, if you will, right? With the COVID shutdown that happened and everything being put on hold, in this marketplace in the Intermountain West, we normally see our spring home buying season starting up in March, and then it really gets going. Well, this year it slowed down with the result of the slowdown, and then when it opened back up, we had the pent-up demand of the spring home buying season. So we're seeing some things where the turn times can become a little bit longer. Sometimes we're seeing appraisals can take a little bit longer. Your initial setup on the loan file can take a little bit longer because everybody now, as a result of this, is also hiring and trying to staff up. And with that, you then see, as you bring people up to speed, right, then it can take a little bit longer. But the great news right now is that we are very fortunate that we're in a place where we can help and serve so many people.
Have 20, 30 more wholesale lenders trying to get the same people. What are you seeing around the market?
Yeah, it's not just the wholesale lenders that are trying to hire underwriters. You've got lenders all over the place, and so I think for companies that have put in, I guess, alternative ways to underwrite, whether by assembly line or offshoring or breaking files up into pieces internally, using juniors, which is our preferred method. That's got support. It's got people they can talk to. If they need to bounce something off someone, they can do that. And so underwriters are looking for that same kind of infrastructure as well. And right now, these companies that have systemic issues internally that don't really do a good job of supporting underwriting, or I know there's some companies out there that just suddenly want to get into wholesale and they think it's just as easy as hiring an underwriter, and next 3 days underwriting on a purchase. And then I've got, a team over in South Florida, they're at 4 weeks on a refi.
Wow.
And so, that's just for the initial decision. And then I have a non-Del Core channel, they're at 1 week on everything, purchase or refi. And so it's just a matter of staffing. So in our wholesale channel, we had about 1,700 loans sitting in line on July 1st. And as of last night, when I left the office at 4 a.m., we had about 830 loans sitting in line. So we've really put a dent in it, and it just
The biggest thing that I've seen, well, just because not being an originator, but looking at it from the industry from a strictly strategy, opportunity, and marketing perspective, what I've been looking at is consumer behavior, and I think what we've all seen is obviously, people are like, okay, economy, job loss, everything that's going on with COVID. Everyone thought everything would shut down, and as we talked about, like our industry's doing more than we've ever done, and we're blessed to be in that situation. Because most corporations, their biggest cost is, other than like people, is going to be their space, commercial space, especially when you're talking about a distributed company that has branches all over the place and operation centers and stuff. It's like, how do we scale that down? Because yes, rates will go back up. We'll get back into those times again where margin compression and all that stuff plays a role. So how do we, right now, I think every lender, on top of doing what they can, because obviously it's an arms race for fulfillment, processors and underwriters. 6 million, and now we're like between like 5 and 6 right now of available, like Lauren said, in the money, right? So that's the thing, is that we cannot, or at least from a lender perspective, if you try to put your fulfillment and operations workflow to where purchasing suffers, and that's not a premium, you're hurting relationships with on the wholesale side, you're hurting relationships with your brokers, you're hurting the brokers or originators' relationships with their agents and borrowers. Like it's an all effect.
Wait.
Oh, he's on mute.
Oh, on mute. Kevin, on mute. What happened here?
I think you could unmute him.
Let me see. It was working fine. Hold on, Kevin. All right, something happened.
Let me ask you a question. So we'll start with Jimmy and then Lauren. So Jimmy,
Sorry,
as far
KP,
as
we'll get you later on an interview.
what are you seeing with you're saying your volume is about 50-50 right now. What are you seeing the reasons for people? Is it just taking advantage of low rates, or is there another goal or reason on why they want to actually refi or even purchase right now?
Okay. Most of my stuff, I'm not doing much cash out, actually. Yeah, exactly. Yeah, exactly. Yeah, and so that's what we're running into. So that's really what I'm seeing. Most of my stuff's rate and term right now or purchase. Purchase is fairly normal. It's just been ramped up because now people that maybe couldn't afford a house last year. Now the rates are a point lower, they can afford 10 or 20 or whatever $1,000 more. And they realize if we don't buy now, it's going to be $400,000 in 2 years. And so they're in a big hurry, which
and virtual with the army and stuff like that, but it's completely service industry. So imagine.
yeah, I mean, like I said, I would defer to Lauren on the numbers when it comes to purchase side and you know, housing and stuff, because he's going to be more in tune with that stuff. But that's the biggest problem here, is that's why we're seeing a lot more purchases. We just don't have enough, and there's a ton of people still looking.
So and I guess in answer to the question, the business that I'm seeing is really split almost and reinvest that and start earning additional income through
Are you
investments.
seeing a lot of debt consolidation, putting credit cards?
About a third
loans?
of, like I said, I'm a third.
Gotcha.
And then the purchase side of things is we're seeing in the Intermountain side, we tend to run historically inverse to the coasts, okay? So, and things that happen within the Intermountain region typically don't swing or get hit as hard as you do evaluate their options. And so I would say right now, over 50% of my time on any given day is really spent in that advisor role and just looking at different scenarios, because you're also finding that with the market and what it's doing and with where interest rates are at, there's not necessarily one simple do this and this one makes sense, because there's different financing options and different structures and strategies that we can deploy for clients that gives very different outcomes. So We're actually at a historic high as well for usable or tappable equity in your home, as the experts refer to it. So again, it's presenting some opportunities for people that they didn't have before, and that they didn't have not just in the last 12 months or 24 months. We're talking in years, okay? And so that's been a really interesting place to be. And so there, again, it's really what people are
something and boom, it's more time. Jason, and I have asked you this before, but what do you see in the next few months, next 3 months, 6 months? I'm looking for a silver lining. Like I was asking KP before.
So, well, I mean, from well, it depends on what you're looking at. I mean, if you're looking at it from an economy perspective, or I mean, I'll just stay within.
Yeah, give me
our
the
wheelhouse.
macro. Give me the
So,
full
you know,
picture.
from the benefit, I think is looking at some of the data, and David Licken shared some of this, is where you're seeing the migration patterns of people away from hotspot places like
I wanna
New
move
York
here.
or California.
I wanna move here.
Or like
I love
Utah,
it here.
right? So,
I love it
and
here.
not talking about
This is beautiful.
and not being political about it, but
Salt Lake City.
you're seeing red states explode with people, and there's a reason for that. It's because one is the restrictions during COVID have been less in some of the red states, and I'm not getting into
The
good or
political
bad or any of that
stuff,
stuff.
yeah.
I'm just saying what we're seeing, right? So depending on your I talked about this in my newsletter a few weeks ago about Tulsa paying people like $10,000 to move to Tulsa. Like they're doing that to where they're paying for moving. They're giving you free co-working spot because more people are going to work remotely. So that's where I see the shift. The silver lining is when you're in, if you're not in commercial real estate, but you're in like executive office co-working.
On. People were thinking lots of stuff, but there's a excellent class on Amazon Prime about the Black Death, the 1348 pandemic. It was horrible. Nobody knew what was going on, and that killed millions of people in Western Europe. So, but ours, the last one was the Spanish flu, 1918, and now this one.
Yeah.
So, Jimmy, you do.
Now, so the silver lining is because rates are so low, you can get house and have that yard, because that's the reality. If my kids didn't have a backyard and things to do in the backyard, I don't know how I'd have made it for 5 months. I'd lost my mind, I mean, God bless my wife, right? Yeah. But, so that's the biggest thing. But I just love VA as a whole. I do a lot of business, but the VA is really the biggest thing for me. And I've kind of structured my business to go that way. Just because I have a passion for it. That's really the biggest thing for me. I love to serve those who have served. I do quite a bit of LEO as well, law enforcement. And it's just a different world for me. Like I said, I feel like a lot of the blessings I have in life and a lot of good things that exist in this country
Your clientele? What do you mostly you target market? Do you and also let me ask you both this: how do you get the leads? Referrals? Are you putting Facebook ads? Are you what are you putting radio ads? How do you get in your clientele? And I'm assuming that it's mostly because you're long time, 4 years is good enough. You're getting a lot of referrals, realtors and stuff like that. How do you get in your client, your leads?
You mean as the dinosaur in the room right now?
The experience, the master class. I call it master class. tied into that on the back, yeah.
The down payment's 20% on a conventional loan. Well, that's just not the case, right, as we know. So it's educating and helping people understand what their options really are. And then you've got the FHA program, and there's the USDA programs as well. FHA is a great program too, and it fits a very specific need for people. It can be a little bit more forgiving on loan structure used, okay, will outperform the lowest interest rate in and of itself every single time. And so, if anything, I would urge people, look at the
Can you give me a
overall-
scenario? Can you give me a quick scenario about it?
Yeah, I sure can. So I had a client we were doing their purchase, and they were at another lender, and they got approved, but there was some challenges with it, and they came in and said, this is the rate that they're giving me. I want that or lower. And I said, okay, well, we can certainly get that rate. That's not a problem. Then as we went through it, and I was doing the analysis, the break even was on that investment. It was actually going to take them longer to recoup the initial upfront points cost than they were going to be in the property. Okay? But the first loan officer or lender didn't take the time to go through that with them. They just saw, I want this rate, I can deliver this, and here's what it is, and they were on to the next one. So for homeowners that are looking at purchasing, make sure that you look at all of the options and ask your originator, what options do we have on this? Okay? And a lot of times it's going to be more than simply a
Because frankly, the rates oftentimes are better with 15% down than 20% down because, you know, the lender has less risk in theory. And so, like Lauren said, you want to look at all those options because oftentimes with 15% down, let's say that 5% is 20 or 25 grand, but your MI is only $50 a month or $600 a year. you're way ahead to pay a little bit of MI in that sense and keep that money in the bank, especially now when everyone's losing jobs and needs the money. That instant liquidity.
Cash is king. Cash is king.
Exactly. Makes up for the fact that maybe they don't have to do a cash.
Some 3% down conventional programs still available as well. But if you look at that and then say, okay, 20% down, take it, say it's a $400,000 house. If you're putting 20% down, we know what that math is, right? When you go in then and say, okay, but what if I put 10% down, okay? And I took that additional money that I was going to put into my house. So the equity that you have in your house really is only beneficial to you when you sell it. Okay, it's almost the analogy that I sometimes use is having a lot of equity in your house is like burying gold bars in your backyard and walking away. Investment account where you're seeing compounding interest at 8%. This will grow much faster than just that equity in the house. And then what you can also do, and this is the part that amazes a lot of people, when I present those strategies to them, a lot of times they can actually take that compounded interest in that investment over here, and if they want to, come back in down the road and apply it towards the principal on the loan, and actually many times have the loan paid off faster that way than using a shorter term financing option.
Yeah. So you're more like a financial advisor. I haven't seen any reports. Our average sales price, our median price over there per the MLS is about 253,000, almost 260. I bet you here is a little bit more, but no home values lost or anything like that so far. Do you think that's going to continue? Are we going to continue seeing increases on values, or what's going on?
Yeah, so I mean, before I get into that, one thing I just want to emphasize, because Jimmy and Lauren brought up I preach and preach and preach. One is, as a consumer, don't listen to the mainstream media because they're not it, right? Don't listen to the Dave Ramseys and stuff. They aren't mortgage professionals. They don't know. I don't care if they're aligned with one. I don't care if they're your best friends.
This is omens. Yeah.
Yeah, but you need to talk to local mortgage experts, the mortgage advisors, the true people that are in this every single day that are really, because their business is legacy, right? So if they put their clients in a wrong loan here was saying like, well, probably in 2020 it's probably going to be about 2.5 to 3%, which is great, but it's like we're not even all the way through 2020, and as Jimmy and Lauren's talking about the amount of, we don't have enough houses, and it really is a seller's market. And I have a lot of great agent friends here in the local. One, Rachel Williams, who's awesome, and she's in the Daybreak area. She's posting about stuff showing like rental prices on places that before at the end of 2019 were probably roughly around like 20, maybe 2,000. Now, if you're in a densely populated metro, maybe you're seeing some of, you're still seeing a seller's market because people are like, okay, maybe I could buy into that now, right? But they're trying to go somewhere else, right? Maybe to Arizona, maybe to Idaho, maybe here, maybe Texas, wherever it happens to be. But so you're seeing that migration of more of like, hey, I know what it was like during this time being around a lot of people. I'd rather to be not around a lot of people or have more open space or more things that flooded with foreclosures. That's not how it works. Didn't even work back during the housing crisis. Mm-hmm. So that's one thing that I'm starting to see a narrative people talk about more, worried about foreclosures, worried about that's going to do to the cost of their house or the property values and whatnot. But I don't see that happening. I think servicers and the industry as a whole, that was basically just given like a big bag of crap to hold.
Now that you're talking about foreclosures, let me ask you this.
Yeah.
Forbearance agreements, forbearance plans,
Yep.
Did it help or did it months ago in Montego, and now they're going into forbearance. I think we got one, I think, or in Orlando. But
No, I've not had.
No?
I've
Okay.
not had any of those happen. What I have had happen though are some clients who went into forbearance. And the way, and as Jason said, it happened very quickly. And on the one hand, as with everything, there's typically, we say, two sides to the story. I actually think that there's three sides to the story, right? There's yours, there's mine, and then what really
and
happened.
the writer, yeah, exactly. Me too. Me too.
The
But that's just how credit works. And so that's where the, like Lauren was saying, just a lot of the confusion and not really explained well.
what we're seeing now, and it's also, the guidelines are agency specific, okay? Some of the programs will allow you, if you're doing a cash out, to use proceeds from the cash out to bring that amount that's due in forbearance current. Other programs say, you can't do that. You have to go and bring your mortgage current first, and then you can close on the refinance. That tomorrow, and I exaggerate tomorrow, that values are going to go down. We're in recession. That's really bad, right? This is the feedback that clients have. It's interesting if you look at what's happened over recession periods. Most people think that when we go recessionary, that housing prices actually go down and crash, okay? The only time that we had a reduction, and a significant reduction in housing, was the 2008 crash, or the Great Recession, as they refer to it. If we go back and look at all of the other recessions that the country's had, and go back standpoint, that's why right now we're seeing a lot of people with an opportunity to both either enter the market as far as being homeowners, or to also, again,
Invest.
restructure their finances or buy investment properties. Okay, that's something that I'm seeing a lot of people do. The other
Yeah,
thing
my girlfriend in Orlando, she's a realtor in Florida, and in Central Florida, all she's doing is flipping homes. It's
Oh,
getting
yeah.
from the investors, straight from the investors. Maybe she'll flip it, or they'll fix it, or the investor will fix it and flip it, or
personal belief and my personal gut feeling is that housing is going to be okay, and the interest rates that we see right now are also going to stay in a nice little good range for people, because if those were to spike up significantly right now, it's going to create some other fundamental dominoes to fall that could be problematic as well.
gotcha. And then, do you see, because you see the numbers and like to research the numbers, have you seen
Oh, I'm just going to wait till it goes down.
Yeah, because
it's not going down in Utah.
The way that I see it, if a lender pull you to a grinder to get that loan, plus you put money,
Yep.
you put maybe a good down payment, you're gonna do your best or your hardest to keep that
Yeah.
property and
Well,
maintain that property.
Exactly. I mean, and it's not easy to get. I mean, this is all I know. So to me, it's easy to get a house if you can prove income and have assets and put down
Decent-
payment.
decent
It's
credit.
good, decent credit. Yeah. The world was different 12 The market's crazy, and so that's what I would tell people. But I don't think there's any better time to buy than now because, you know, one of my old properties, my next door neighbor took a 45-year-old a split entry house. They were renting for $2,300 for a 5-bedroom, 2,300 square foot split entry house. That's ridiculous. You can own that house for less than that. You know, so if you qualify, you know, get with your local, you know, your mortgage banker, broker, whoever it may be.
A strategy and marketing perspective, my thoughts are this: is that right now, I know it's tough as a loan officer, as a lender, you know, record production, right? Everyone's making money. What I don't want to see happen is having that short memory and not remembering what it was like the end of 2018, beginning of 2019, where some lenders were I do feel with the right focus and the right right investment, within 5 years, underwriting won't be like it will be like a 2-hour turn time, because the computers are just going to be able to match everything and make sure it's okay. Then someone oversees it and then on to the next file, right? Because I think as an industry,
you see little by little, like one day certainty with Fannie Mae, stuff like
exactly,
that.
just like we have, but I think that's going to be more and more, because I think lenders should be seeing the investment in that technology to make things better and more streamlined, not just for the consumer, but for the originators and everything else. And we're starting. create an actual legacy business for themselves with what's happening right now.
Exactly. Lauren?
What's parting words, huh?
On this season finale.
One of the things that I would recommend that people do is when they're entering into the process, whether it's buying or refinancing, that they spend some time doing due diligence on it. It's the biggest financial investment and the biggest debt that we're going to have. Okay, it's important. Job here, but you can live anywhere that you want in the U.S. So we're going to see some very fundamental shifts, I think,
Yeah.
in the industry. There are some wonderful opportunities right now, and I think that we as an industry and as professionals, for everybody's benefit, need to focus on quality and need to focus on really driving the experiential side of it so that it makes it easier, better for people. And then on the other hand, I would also say to our consumers that are out there and homeowners,
Every night was my launch, so set expectations, and that's a great point. Jimmy?
I think before we started the grand finale, I kind of gave my speech, but I would say this, you know, obviously I'm a mortgage broker. I have a passion for it, but really I'm a marketer and a sales guy first, before a mortgage lender, and so it kind of combines for those of you that are in the industry with me. Now is the time. I can't emphasize enough. Now is the time for technology and people. I coach with a gentleman who believes you put the technology in place and then you We don't see the same things we saw then. We're just not kind of, there was a very flippant attitude about lending in real estate back in the late 2000s, because literally, if you've seen the movie The Big Short, you could be a stripper and fog a mirror and have 10 houses, right? That doesn't exist in our world anymore. So
She had 9 or 5.
yeah,
How
I can't
many-
remember. It was a lot, right? So that's my biggest thing is don't be afraid. Talk to someone that can advise you through the process. That's really our job as advisors.
Or if you're salaried, there's people are saying that if you're self-employed, people get nervous about that. There's actually a lot of different loan programs that are out there today. As an example, if you're buying investment properties, you can actually buy an investment property now with what's called the DSCR loan, which is a debt service coverage ratio program, where there's no personal income needed to buy that investment property. It's based on the cash flow of the property. Right. There's bank statement programs as well that are out there for self-employed. So there possible would be to realize down the road that there was a program that worked for you that you just didn't know about.
Correct. Excellent. Well, this is the season finale. On next season, well, I want to really thank the group, the panel here. I want to thank Kevin, KP from PRNG. I want to thank Jimmy, Lauren, and Jason for being here on this, the first ever Mountain Mortgage Summit, here broadcasting live from beautiful Salt Lake City, Utah. In our Mortflix app, you'll be able to watch